Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is August 5th, which is a Monday, 2024. So we're going to change it up this week. This is different than our normal format of reviewing economic data, markets, and doing an economic preview. We're actually going to go back just a little bit further to take a look at the economic data over the last 3 weeks. So as we sit here today, over the last 3 trading days, we've had a significant equity sell-off, and people are scratching their heads trying to figure out what happened. And we're not entirely sure, but we're going to go over the economic data, come up with some conclusions to it, and just try to put things into context for you. So real focus here on the economic data and not the emotion, hopefully. So if we take a look just 3 weeks ago, as we did a podcast, we'll show the slide of economic data that came out on Thursday and Friday, July 11th and 12th. And just across the board, it's really positive. So CPI year over year, the headline inflation rate, that rate year over year. Initial jobless claims actually better than expected that week. We're expecting 236, we had 222. PPI was fine, core PPI was fine. The Michigan consumer sentiment number that came out on that Friday actually came in better, slightly worse than expected. It was expected to be at 68.5. It came in at 66. So all in all, we finished that week fairly strong, and that's when the S&P 500 ended up peaking over this short cycle. So when we take a look back from year to date, as of July 12th, S&P 500 was up 18.6 at that time, driven strongly by NASDAQ, up 22.6%. At that point, growth in the U.S. was up 14.2%, beating value up 9.3%. And the U.S. bond index, Bloomberg U.S. Aggregate Bond Index, was up slightly for the year, 0.82. So that was the peak, S&P 500, the following day, following business day. And we've traded off now, and we've had 3 significant down days, including this Monday. So since then, we'll just go over the economic data. We've gone over some of this already, just in rapid succession. Just take a look at some of the data points, and the conclusion here, our suggestion is, in terms of economic data points, they're solid, some strong, some a little bit weaker. Certainly labor market weakness. But overall, it certainly does not look like a bad picture, and certainly doesn't look like something that would warrant a more than 10% sell-off from the top on the NASDAQ. So if we take a look on July 16th, retail sales was expected to come in at 0.1. It came in at 0.0, so it's flat month over month for June. Not a big deal, maybe a little slower than expected. Then we had a jobless release that week that was supposed to come in at 225, came in at 243. So that's kind of like the first real suggestion of maybe some weakness in terms of labor markets. Tuesday, July 30th, consumer confidence. This is the government's version, actually came in better than expected. Expected 99.8, came in at 100.3. A big data point, July 31st, Federal Reserve had their open market committee. They had their press conference on that Wednesday. Kept rates where they're at, Fed funds 5.25 to 5.5, but very importantly noted that they are changing their focus. They have a dual mandate, price stability, full employment. So heretofore, it has been a real focus on inflation, price stability. They mentioned at that point they would be changing their focus to jobs, to full employment. So you would think that was a good thing, and markets in part reacted well to it. But since then, we had an initial claims number the next day. It was supposed to come in at 233,000, came in at 249. And then the big one, and this is the big one, just last week, Friday, non-farm payrolls and unemployment rate. So we have said on these podcasts, we really didn't think the strength in the labor markets was quite what the Bureau of Labor Statistics was showing us for non-farm jobs that have been added over the last year. The consistent pattern was they would beat expectations for a given month, but then revise down the prior 2 months. We saw that 9 out of the last 12 months. Well, for this month, they didn't come close to the number. Consensus was expecting 170,000 new jobs in July, actual 114,000. Also, unemployment rate was expected to come in at 4.1. It came in at 4.3. So this clearly has a lot of economists and investor attention. So worried about economic weakness, worried about whether or not we're going into a recession. So we'll just take a look at what the numbers were, the returns over that 3-week period from mid-July until the end of last week, and take a look at a year-to-date. So very tough stretch. S&P down 4.7, 4.8% from mid-July to the end of last week. What really flipped around, growth versus value here in the U.S. Growth down 7%. NASDAQ was down 8.8%, so growth down 7%. Value actually up 0.5%. Small cap, surprisingly, beat large cap over that time. Small cap only down 2.4%, large cap down 5.5%. The big news over the last 2.5, 3 weeks has been fixed income. So investors flooding into the fixed income market. The 2-year yield dropped 57 basis points. I don't know if this is unprecedented, but it is a very rapid and violent move. 10-year dropped 39 basis points. So over that time, where you had the S&P 500 down 4.7%, the Bloomberg U.S. bond index was actually up 2.4%. So now let's take a step back and take a look at year-to-date returns. Last week has been ugly, no doubt about it. Let's not lose sight of the fact that 2023, fantastic year. 2024 year-to-date, still this is a very good return at this point. Today we'll take some out of it, but year-to-date, end of the day Friday, S&P 500 up nearly 13%. Value beating growth, value up 9.9, growth up 6.2%. International markets well below the U.S., so our domestic bias is really good. On a year-to-date, almost all the returns in the bond market have been in the last 3 weeks. So year-to-date, Bloomberg U.S. Aggregate Bond Index up 3.2%. So I think if you ask most investors January 1st, 2024, how they would feel about a full year return of equity being up 13%, S&P 500, and bond up 3.2%, they would definitely have taken that. So even after the big sell-off on Thursday and Friday of last week and today, wherever it ends up, so far, the returns year-to-date have been really good. So let's take a look at some more contemporaneous economic data, and we look at the Federal Reserve, their expectations for GDP growth here in the third quarter. GDP growth was unexpectedly strong in the second quarter, came in at 2.8. Most economists were at 1.9. Atlanta Federal Reserve was at 2.9, so almost nailed it. Atlanta Federal Reserve believes still here in the third quarter in GDP growth for the U.S., 2.5%. Now, one thing that has really changed over the last 4 days, this is an amazing drop, inflation expectations. So we often show you the 10-year break even, 10-year treasuries minus 10-year tips. And it has been fluctuating by between 2.2 and 2.4 pretty much all year. Very tight band, but a really low number. Well, last week that cracked to the downside. So as of the end of the day, Friday, expectations for average inflation rate over the next 10 years by this metric, 2.04%. So super low expectations for the inflation rate over the next 10 years. Fed funds, this has changed dramatically also. So recall, and we've mentioned this many times, coming into 2024, investors had priced in 6 interest rate cuts, or 1.5% by the Federal Reserve by the end of the year. Didn't happen. Federal Reserve didn't make any changes, still has not made any changes yet. So the expectation dropped to, by the end of the year, it was an even money bet that we would get 2 rate cuts. So taking a look now, the expectation is almost certainty that we're going to get 2 rate cuts in September. September meeting, 86.5% expectation or probability that we'll get 2 rate cuts. A week ago, that number was 11.4% probability. So it's amazing what a difference a week can make. So end of the year, expectations now almost locked in, probability-wise, that we're going to get 5 rate cuts. Just 3 weeks ago, it was 2. Now the expectation is 5, a 97.5% probability built in that we're going to get those 5. And the probability of that happening just 1 week ago, 0.2%. So in terms of the economic data that we have, I just want to stress corporate earnings have been a huge driver. The biggest reason the S&P 500 is doing as well year to date as it has. And through the end of last week, earnings looked really good. So we have 75% of companies that have reported so far. 78% of the S&P 500 companies have beat expectations. So coming in to this quarterly period, the expectation is S&P earnings would grow 8.9% year over year. At this rate, it's going to be 11.5%. So corporate earnings, surprising to the upside, very strong at this point. Now, one thing that's happened over the last couple of days is valuations have come down, still higher than average, but as of the end of the day Friday, the forward PE multiple on S&P 500 earnings, 20.7 times. The 5-year average is 19.3 times. The 10-year average is 17.9 times. Now, a chart that I've shown before that I did not include in this deck was JP Morgan breaks down the Magnificent Seven and then the other 493 S&P 500 components. Big difference. So the Magnificent Seven, the forward PE multiple as of, let's call it 2 weeks ago, was 31 times. The rest of the S&P 500 was at 17 times. I just mentioned the PE average over the last 5 years for the S&P 500 has been 19.3 times. For the 10-year, it's 17.9. So we can reasonably argue that the Magnificent Seven is or is not overvalued. I think it's pretty clear the rest of the S&P 500, for which we expect increasing or accelerating earnings growth through the rest of the year, the rest of the S&P 500 ex the Magnificent Seven look reasonably valued. So I'll wrap this up by saying a few things. Year-to-date returns, as I mentioned, both on fixed income, U.S. equity, international is okay, but they're all positive and very strong for the S&P 500, very solid for the bond market year-to-date. I will say that the sell-off that we're seeing right now in the U.S. equities, it's not really unusual. Actually, what's unusual is how complacent investors have been over the last year. If you take a look at the VIX chart, the implied volatility on S&P futures, we had a long period where it hovered around 13 to 14 is the metric. As of today, at one point today, it hit 60. It's come back down to the high 30s. But we have been in a period of very low volatility. So having some volatility, not a surprise. We often get it. I will point out that on an average basis, if you just take a look back to the 1980s, the average drawdown in any given year is 14.2%. That's the average. As of Friday, it was only 5%. You can go back 2 years ago, 2022, it was 25%. 2023 was only 10%. But the point here is having a drawdown during any given year, not surprising at all. We did talk about U.S. labor markets a little bit. Now, that is definitely out of the economic metrics. That is one that appears like it has weakened. We're not really sure that it has. We suspect the labor numbers that we've been seeing are not really accurate. If we look at the ADP number, much more stable and at a lower level than we saw from the BLS, again, which leads us to believe maybe the numbers that we've seen, maybe they're overstated. So labor markets, we don't think have just suddenly weakened and have fallen off the cliff. So most of the major economic indicators, as we've already mentioned and gone through since the market peaked 3 weeks ago, there are a couple that didn't hit expectations, but on average are solid to actually strong. So one other chart to go through before I give you the advice. Market timing. We don't try to time the market. We have no idea where the market's going at any point in time. We always love to reiterate and reinforce to our clients, to investors, that being out of the market for even short periods of time can really damage your returns. We are showing a chart today that shows you going back the last 30 years, what happens if you miss the best 10 days and 20 days, 30 days. And it's pretty remarkable, as you might expect. You miss the few really large days, and it dramatically hampers your returns over time. But then secondly, and I just love this chart that we have here on the right-hand side of the screen, it simply shows you all the big days that we've had, really going back to the tech bubble back in 2000. And the point being is that most of the really big up days that we see in the equity markets, thereafter we've had some really big down days. So give you a little bit of hope that, again, we're not sure, we're not calling the bottom, not saying the market's going to inflect up. Historically, though, that has happened more often than not. So our advice to you as an investor, hopefully as a client, is don't overreact to the economic activity, the data that you're seeing, or really I would say much more the way the market has moved the last few days. We do feel it's an overreaction. Maybe we'll be proven wrong, but what we have been proven right at is it does pay not to overreact, not to sell equities, certainly at a potential bottom, and to do what we consistently do, and that's provide diversified and balanced portfolios without making massive trades trying to outguess the market. So that's it for a very long session here today, but thank you very much for attending. We'll look forward to seeing you next week. Thank you.